The first quarter of 2025 is over, and what a wild ride it's been for investors. In this episode, we're going to take a look back at all the things that impacted the markets in the first 3 months of the year, and then we're going to turn ahead using our crystal ball to tell you how we think 2026 is going to shape up. Welcome to the Fishbowl. I'm Brad, Certified Financial Planner, here with Matt, Certified Financial Planner. We're with Seaside Wealth Management in Carlsbad, California. Let's dive in. So we rolled into the year on a high. I mean, we had a pro businessman in the White House and the Oval Office. We thought things were going to be great, but what's happened since then?
Yeah, a lot of people thought that things were going to be great with the businessman, pro-business, and everything like that. But we rolled into the year, like you said, at an all-time high, and then markets hit an all-time high in February on the 19th, about 61.47.
Right. We're like sailing.
Yeah.
Hey, this is great.
Everything's happening like it was supposed to. But,
Right.
But then 16 days later, do you know what happened?
We hit a correction.
Right. And so a correction, just by definition, is when you go from the all-time high to 10% down in the market. So dropping 10% from its all-time high.
Right. I know. Awful. And then it ended up, the S&P 500 closed the quarter down about 4.3% for the quarter.
Mm-hmm.
But then when the tariffs got serious and they rolled out, we had a 10% correction in 2 days.
Two days. And I mean, a lot of people can't stomach that at all. And they're making poor decisions with their investments when things like this happen.
You know, I feel like markets are moving faster than ever before. I mean, 80s, 90s, 2000s, today, the speed at which things are happening, I think it's because information is trading hands so fast.
Absolutely. I mean, before they were writing handwritten tickets and setting them up the tube to make the trades. And now you literally click of a button and this thing's happening.
Instantaneous.
But
it's funny because you watch how, it's not funny. It's, 10% correction in 2 days. Brutal. Mm-hmm. It's brutal. And to your point, a lot of people got, fortunately, our clients have been coached. They know that this is normal. Unfortunately, you've got a great saying about volatility.
Volatility is your friend. I mean, use it to your advantage in certain situations.
And also, I love what you say. It's the price you pay for the wonderful long-term returns that you get.
Right. And I mean, a lot of people will see these fast downturns in the markets or fast upturns, and then they'll try to make decisions based on the information that they're reading. And you made a really good point that information is going so fast that if you are reading it, it's probably too late for what you're trying to make a decision on.
Okay, so great point. Early April, markets down 10% in 2 trading days. And when you look at the trading, it's like a waterfall. It's like falling off a cliff. That's how fast it went down. Mm-hmm. And then a few days later, the next week, Trump announces he's going to ease the tariffs. Markets up 9.5% in a day.
It's wild, yeah. So putting a trade halt for 3 months, and then the market shoots up very next day. I don't know anyone, even us with our crystal ball now.
Oh, yeah. Love this thing.
Even with the crystal ball, we still couldn't have predicted how fast that was going to shoot up.
No, and I think you make such a great point. Like when you look at the data, there is absolutely no way that you could have sidestepped and gotten out in time and then gotten back in. It just moved too quickly.
And, you make a great point there, too, is that a lot of people that we hear, they get lucky on one of them, getting out at the right time or getting in at the right time.
Right.
But then you really have to be right twice in order to take advantage of these things, which is near impossible to do.
Right.
And it always gets me worried or concerned with someone that does get lucky in making it the right decision, because then psychologically it gets them thinking that they can do this over and over, which it just can't happen over and over.
That's absolutely right. And all right, so back to Q1, we have S&P nearing a bear market. The Russell 2000 hits a bear market. NASDAQ hits a bear market, so down 20%. I mean, things are bleak. And then tariffs are paused just a little bit and things rebound. But S&P still down for the year. The Russell 2's down for the year. And yet there's some other things going on that are actually positive. The media doesn't tell you. Mm-hmm. You got a devaluing currency just a little bit, which is causing a couple of interesting factors. International investments are doing great.
Right, yeah, and you bring up a good point there as well, of that when people are watching the news or the media, well, a couple of things. the media is out there to try to get clicks. I mean, they're selling fear to make you worried about what's going on. And they're not necessarily lying. I mean, the U.S. markets are down, but when they're saying the markets are down and your portfolio is getting crushed, I mean, 95, or I'm making numbers up, 95% of the time they're talking about the S&P 500, which is just the large U.S. companies, the 500 largest U.S. companies.
Right.
And so although that portion of the portfolio may be down, then other portions, if you're globally diversified, could be up, to your point. And so international markets are doing fantastic. And then also the Russell 2000, so the small U.S. companies are actually in worse place. So if you've got international exposure, emerging markets, maybe real estate, bonds, I mean, these other areas, you could be trimming off of these spots and then go purchasing the U.S.
Right.
And so buying low and selling high in real time.
We all know that we need to do it, but no one has a good system for doing it well. But Matt, how about all those advisors that loaded their clients up on U.S.-based investments over the last 5 years?
I got to be honest, I am loving this time right now. I mean,
right.
With some of these people in only U.S. investments, maybe the last 10, 15 years, they've been doing okay, but it was bound to switch at some point, and we didn't know when it was going to happen.
Right.
And so a lot of these gains that these people have seen have just been getting wiped out and really hurting their retirement long-term planning.
Right. And when you look back over the decades, you see a similar phenomenon unfolding there in the early 2000s, where dot-com bubble peaks in 99. We had the tech wreck of 2000 to 02. We had a little recovery, and then the mortgage meltdown of 07 through 09, and a globally diversified portfolio held up well. Well, meanwhile, S&P 500 loses 1% per year for an entire decade.
Right, the lost decade. And so you say it best of when, if you did retire during that time and you were taking 5% out of your portfolio and you were only a U.S. investor during that time, then you're going back to work. And I mean, if you're doing retirement...
You're the Walmart greeter?
The Walmart greeter. No offense to any Walmart greeters out there.
Right, yeah, we love you, Walmart greeters.
But if you don't want to go back to work and your whole plan to retire was to live life and not go back to work, this really derailed you and caused some serious issues.
Well, and it's funny because so in March of 2009, international investments were red hot, and the S&P 500 was ice cold for 10 years. And people were going, hey, we're going to ditch the U.S., right? We're going to load up on the international because it's been hot, and we're going to get rid of this old dead dog, the U.S. investments. And I said, no, not because my crystal ball works. I'm telling you, it broke. It broke so long ago.
But this is one of the reasons why we may see the international markets be going up, is because people are leaving the U.S. equities because of fear to go purchase the international investments, which is fine. But really what you're doing is chasing the shiny object, and should have stayed disciplined and had your
the whole way through.
Right.
That's right. And so when you look at the last 3 to 5 years when S&P is just red hot, you mentioned it earlier, though at those times you trim, you sell just a little, and then you assess which asset class is down, and then you buy the one that's down. So you have a disciplined process of selling high and buying low.
Why don't you let the winner ride? Why do you not let it just keep going?
It's so tempting to do that, right? You want to bet on the winning horse, but the answer is look at what's happening this year. S&P's down, Russell 2's down. You get hit harder if you had that extra concentration in the portfolio.
Well, speaking of concentration, then what about individual stocks of the large U.S. companies as opposed to the index?
Oh, boy, that is a loaded question. It's a loaded question. So in general, I think stock picking, trying to be an active stock picker, is just a fool's errand. I mean, you look at how difficult it was, the 10% correction in 2 days and a 9.5% recovery. It's also that difficult to pick your individual company winners. So I would much prefer using ETFs or index funds. However, with one caveat to that, in taxable accounts, I think this is really where I think this is the future of, if not the present of investing. Direct indexing, in my opinion, is to me a really nice blend, and you'd use it for taxable accounts only. But you can have the guardrails that an ETF or index fund provides, but you can then get exposure. You can basically build your own ETF in a way that allows you to take advantage of volatility like this. So you could be selling things at a loss for tax alpha, for tax savings, and then replacing it with similar securities, not on an active, I think this one's going to outperform and this one's going to underperform. you're just managing to an index. You're replicating an index.
Mm-hmm.
To me, if you're going to do individual stocks, direct indexing would be the way to go.
Yeah, I agree. But just keep in mind some of the things, just larger dollar amounts to be able to purchase these just because you are buying the individual securities.
That's right. Yeah, you're absolutely right. And taxable accounts only.
Yeah. So going back to the international investments,
Okay.
how have they been doing this year? You said they're doing good, but
International developed is up about 13%. International small is up around 10. Emerging markets is up high single digits. I mean, it's really nice to see that. And they've been doing fine over the years, but it's nice to see the outperformance that, hey, look, we figured this would be happening. If you ask me, I thought it was going to happen maybe 2-3 years ago. Going back to that crystal ball, mine's broken clearly. Right. But having that disciplined process, those are the asset classes that we've been buying into over the last decade as the U.S. investments have been hot.
So the patience of these investors is starting to pay off, and they're being rewarded. So we talked about a lot of investors being heavy in U.S. or all in U.S. What if someone's in 70% U.S. in their portfolio and 30% international? Is this the time to now shift from 70-30 U.S. to international to 60-40?
Go more international?
Go more international?
Oh, that's a great question. I don't know. That feels market timey to me, which is just hard. But the person that does have the 30-40% exposure to international, you're absolutely right. They're in much better shape today. I mean, all of our clients are at least neutral or positive territory, especially with bonds and fixed income in positive territory too. But it's tough because we looked at it over the last decade of, all right, do we shift more into the U.S.? But, we maintain the discipline as painful as it is. Mm-hmm. It's kind of like exercising or, eating your veggies. We all know what we need to do, but it's hard to do.
Yeah. I mean, but you mentioned all the double-digit positive returns in international, and then diversified portfolios, at least with our clients, being even. I mean, that's the beauty of the diversification, is that we won't be in last place like the Russell 2000, but we won't be in first place. It's kind of just a combination of all of those different asset classes. Smooths out the ride and prevents you from making poor decisions, or helps prevent making poor decisions along the way.
So a couple things. So let's talk about, for the person out there who's in retirement, who's having to navigate this volatility and they're needing to take money out. And you think about April, how volatile April was, and really the first quarter, it was hot for a minute, and then it got cold, and then it got ice cold. How does that retiree who's taking money out, how do you coach them, or how do you help them think about it?
Great question. I mean, a lot of things to unpack there, right? I mean, if you've got the proper planning that you've put in place, so hopefully you've got your emergency fund or some cash buffer there. Maybe you've got some bonds in your portfolio, but more importantly, if you're working with an advisor that has you in a globally diversified portfolio, like we've been talking about, not all of the areas of the market are down. So you're able to actually target which area of the portfolio you're taking distributions from. So you're not necessarily, maybe your portfolio is down overall, but you're not necessarily selling your investments while they're down, if that makes sense.
It does. I love what you were telling me, that you were having your clients, hey, international's hot this year, when they need to take a distribution to pay for their monthly expenses. Let's sell international. Let's sell the bonds, which are up. We were doing the same thing in reverse last year. U.S. was hot, so we can trim U.S. to fund those distributions.
But more importantly, you should have a financial plan in place and show you what you need to do, not now, but also in the future, to make sure your plan stays on track, and running it through that Monte Carlo simulation, which is taking your plan through 1,000 randomly generated market scenarios.
Right.
And this is important because although it doesn't feel good when your portfolio is down, if you've been having your plan and regularly updating it, we've taken these things into account. So it's not a fun experience, but it is part of the investment experience to make sure that you get those returns that you're looking for over the long term.
It's so interesting too, because when you stress test it, you don't know what's going to cause a decline like we've experienced earlier this year. It happened to be tariffs. Who would have thunk? Tariffs. That wasn't on anyone's radar. So, over the next 30 years, there's always going to be these things that no one anticipates, no one thinks about, but stress testing the plan. We know that the volatility is going to be there. We just don't know what's going to cause it.
And for us, I mean, our confidence zone is 82% probability of success. And
Right.
some people don't like this. You have a good saying of like, it's like getting a low B in school, and most people don't want a low B on their retirement.
Yeah.
But the way I wouldn't look at that as an 18% chance of that you're running out of money in retirement. It's that there's an 18% chance that you're going to need to make adjustments along the way.
Yeah.
And so that's, again, why it's so important to review the plan.
Yeah. So let's turn the page a little bit and let's talk about 2025. Where do you see things wrapping up, and how do you see us heading into 2026?
So just like you started it off, I mean, we've got a businessman in the White House, and whether you're blue or red, I mean, I just don't see I don't see negative returns over the rest of the year going into 2026. I just see, as a business person, that you want these great companies, not only in America but around the world, to profit, to support their investors.
Yeah. So okay, the tariffs were paused. I'm thinking volatility's got to be around the corner if they come back.
Volatility is here to stay. I mean, with information going so quickly, I think that's just a new normal for investing too. It's always been there, but I think it's going to be more prevalent.
Heightened
Yeah.
this year.
Yeah.
So I'm telling people, buckle up your seatbelt, put on that helmet.
Yeah.
What's interesting, though, is I am curious now because you're starting to see some global trade deals get inked. And I think Britain was the first one, I know. And so I almost wonder, okay, was Trump using the threat of tariffs? And we saw how violently the markets did not like that threat at all. But maybe that was used as a conversation starter to start the negotiations with other countries.
Absolutely. There are a number of countries that came out that are wanting to make things better too. So markets may like that. It's just the uncertainty of what's going to happen is what makes those ups and downs.
Right. So, well, speaking of other countries, I know we have a new pope these days, right?
First pope coming from America, Chicago, actually. And so, I want to make some predictions going into the next year, is that although it's the first time that we've had an American pope, I'm going to say that every time we've had a pope from America, that the markets have been up.
I love it. First one.
First one,
right.
yeah.
He's got to be a boon. Good for American stocks. No, I guess we'll have to pray for good growth.
Yeah, absolutely.
Yeah. All right. So other things, as we think about the year. Interest rates, that's another one that fascinates me. You say we got a pro-businessman in the White House. He's a real estate guy, and so he's got to be in favor of lower interest rates.
Yeah, I would think so. But him and our boy, JP, are not playing nice in the sandbox.
And the market doesn't like it when they clash. JP, Jerome Powell, Fed chair, love it.
Yeah.
But the market doesn't like it when JP and Trump fight, do they?
I know, right?
Yeah.
So we'll just have to wait and see. The best thing we can do is just stick to the discipline of the globally diversified portfolio and stick to your plan.
Yeah. But it's interesting. So I think, if interest rates do come down, I think that's going to help real estate. I think it'll help anybody borrowing money. I'll be curious to see if that happens maybe back half of the year.
Yeah, we'll see.
Yeah. And then any thoughts on the international performance? You think it's going to continue?
Yeah, I think with the people still flocking away and being scared of the U.S. economy, that it's just going to be a natural move going to international.
Right. Yeah, I tend to think that the dollar is going to continue to soften a bit. If nothing else, just fundamentally, it's been so strong for 10 years. So bad for the travelers. We've been telling our travelers the last 10 years, dollar's hot, not so wonderful for international investments, but travel while you can.
That's
there's
right.
a great exchange rate. So that exchange rate may be softening, but I think that's going to be the wind in the sails for international. I think it's going to be even, we got commodities, which we're not huge fans.
Right. So commodities are the thing that are supposed to be it reversed as the market. So if markets going down, commodities are going up. So we're seeing U.S. markets go down, commodities doing okay. But I mean, you should only keep like 3 to 5% of this in your portfolio.
Right.
my thought is that it's such a small percentage and they've been a drag on portfolios for so long.
Right.
I'd rather see that 3 to 5% go somewhere else in the portfolio that's
Right.
has more consistent returns.
Right. Although I do got to give a shout out to my man, Jeff Foreman. Jeff, I know you're out there. He has just pounded the table for commodities for 15 years. And his joke at our reviews is like, okay, I know I've underperformed for 15 years, but maybe your time is coming, Jeff.
It's his time to shine.
Yeah. But I'm with you. No more, 3%, 5%. We would prefer to steer clear of that here. But that's another thing for people to think about.
Right.
So, all right. Well, with that, I think that, it's clear volatility is here to stay. Maintain that discipline. Make sure you're rebalancing through this. You're managing through this market volatility. You're not trying to time it. And if you have questions or if you just need help with this, I mean, it can be a lonely road to travel. I mean, if you're doing this on your own, there is so much going on. So any of our listeners out there, if you need any help, get in touch with us. We're happy to help you. But Matt, it's been a pleasure.
Yeah, always.
Yep. We'll see you on the next one.
Sounds good.
Okay. Once again, I'm Brad here with Matt, and thanks for listening. You can find the show on Spotify or wherever you listen to podcasts by searching for the Fishbowl Podcast. Make sure to follow the show and also share this with anybody who you think can benefit. Word of mouth really helps us grow. And until next time, just keep swimming.